There are three categories of mortgage loans based on price and risk. Well-qualified, low-risk borrowers will fall into a low-cost category of prime. Borrowers with a moderate risk will have a moderate-cost mortgage known as HPML, or higher-priced mortgage loans, as defined by TILA. High-risk borrowers will pay a high cost. These mortgages are known as TILA Section 32, high-cost loans. In order to determine which category the mortgage loan is in, we look at an index called APOR. The average prime offer rate. This APR is based on the average of what prime borrowers receive in interest rates, costs, and other loan terms. A mortgage is considered moderate cost, or a TILA Section 35 higher-priced mortgage loan, when it exceeds the average prime offer rate by 1.5% if the loan is a first mortgage, 2.5% if the mortgage is a jumbo loan, meaning it exceeds the conventional conforming limit, or 3.5% if the loan is a subordinate lien, like a second mortgage. Knowing when a mortgage becomes an HPML is as easy as 1, 2, 3. Just don't forget the 0.5. If the mortgage is considered a higher-priced mortgage loan, the Truth in Lending Act requires two things. 1. The creditor must set up an escrow account for the borrower for the payment of property taxes and mortgage-related insurance premiums if the loan is a first lien. Secondly, the appraisal must be performed by a certified or licensed appraiser, and the appraiser must conduct a physical inspection of the interior of the home, not just the exterior. As defined by the Truth in Lending Act, a mortgage becomes a Section 32 high-cost mortgage in at least one of three ways. First, if the mortgage loan's annual percentage rate, APR, exceeds the average prime offer rate by more than 6.5% for first liens, or 8.5% for subordinate liens, then the mortgage will be considered high cost. Or, if the creditor charges points and fees that exceed 5%, the mortgage will be considered a high-cost mortgage and subject to Section 32 of TILA. Or, if a creditor tries to charge a prepayment penalty for more than 36 months, or that is more than 2% of the amount prepaid, the mortgage will be considered a high-cost mortgage, and subject to Section 32 of the Truth in Lending Act.